Hello and welcome to the webinar. Welcome to everyone. We're here today, very excited to be discussing a webinar on framing the solar bankability issue in Africa. This event is organized, or this webinar is organized as a prelude to an event that Solarplaza is organizing in Nairobi later this year in November. As you can see already, we have a number of sponsors who are supporting us and partners. I would like to say a special thank you to all of those who have already signed up to sponsor and support us in this event. We're very much looking forward to to having the chance to go more into depth on some of the issues surrounding solar bankability in Africa. It's a region that Solarplaza has quite some experience in, is becoming increasingly. We're seeing a lot of movement, and we're very excited about the opportunities. Just a few practical notes before we start. We would definitely like to actively encourage all of you to ask questions during the webinar. This is an interactive webinar that we'd like to host. We will have some short presentations from our speakers, which I'll introduce shortly, but we will also have quite an extensive time for Q&A and more extensive discussion. So yeah, please feel free. On the right-hand side of your screens, you'll see a tab that says questions on it. You can direct your questions there. Also, with regards to any technical issues, we do have a team on standby. If you need any help, you can also just use the chat box also on the right side of the screen. And also the presentation slides will be available after this webinar, as well as the actual recording of the webinar. So this will all be made available to you. Just very quickly, a brief overview of the agenda. We have two speakers today. We have Andrew Johnstone, the CEO of Climate Fund Managers. I'll introduce him in more depth shortly. We have Arno Broad, who's an infrastructure finance specialist with the World Bank, and as I mentioned, we'll have some time to go into depth on these topics. Just very briefly, for those of you that don't know us, Solarplaza, we're a company that's involved in empowering professionals in the solar industry. Our goal is to accelerate the energy transition. We've been in the industry since 2004, having organized over 80 events in more than 25 countries. You can see some of these on the map. Obviously, we started a lot of our focus in Europe and North America. We also have extensive experience, obviously in Africa as well, but in emerging markets generally. And this is, a region which we're very much focused on, and we have a network of over 50,000 solar PV professionals. Specifically about the event that we're organizing in Nairobi, it will take place on the 1st and 2nd of November in Nairobi, Kenya, but it is indeed, focused on not just the Kenyan market, but it's a regional event. We're looking specifically at, the topic of unlocking capital for solar project development in Africa. We're looking to bring together over 300 international key players, and these include, DFIs, development banks or developers, IPPs, EPCs, and other facilitators of the industry. And also one, key selling point of this event, and one of the key elements that differentiates us from a lot of the other events that are going on, is that we're focusing on three specific electrification segments for solar PV, which are, grid scale or on-grid solar projects. We're looking at microgrid scale projects, as well as off-grid pico solar or household electrification for rural applications in Africa. So we're focusing on all three of these segments, and specifically on the financing and issues surrounding bankability of projects. So our goal is really to bring together a mix of around 40% investors and financiers, 40% project developers, EPCs, IPPs, and 20% industry facilitators in order to really push projects forward. And another key distinguishing factor is that we're spending a lot of time in networking and matchmaking. There'll be several facilities available for matchmaking, and we'll be actively trying to connect capital and projects to really move things forward in the solar industry in Africa. Very briefly, again, as I mentioned, we have three focuses, or three separate tracks or streams during our conference: on-grid or grid-scale solar, microgrids, and off-grid and lighting. We have a series of plenary sessions. We also, with regards to the track record that Solarplaza has with regards to Africa specifically, we've organized a number of events. These are just some of them. We've organized a number of events in South Africa. We organized an event in Senegal, and also recently in Amsterdam, we organized an event, co-organized an event with FMO, Making Solar Bankable, in which we had a huge focus, obviously, in emerging markets and specifically in Africa. And we are very happy to be bringing some of these topics, financial topics, to Africa. So our first speaker today will be Arno Broad. He is an infrastructure finance specialist at the World Bank. But just quickly before I introduce Arno, I would like to quickly start by asking a question. I mean, obviously, one of the things that Arno will be discussing, which I think a lot of you are familiar with, is the Scaling Solar program. And I think a lot of us are aware of the very low tariffs that came in the recent bid in Zambia. And one of the questions that comes about is it was a surprisingly low rate, but basically we want to sort of understand from you now. We're going to ask a quick poll question to get a sense from the audience of what you think. What do you consider a sustainable price for solar projects? I mean, I realize it's quite an open-ended question, but in your eyes, what do you consider a sustainable price? Looking in the sort of 5-year term, what do you consider a sort of sustainable price, and does this fit in actually, interestingly, with the recent prices we've been seeing in Zambia and what we might be likely to see in further tenders in Africa? So I see quite some activity, quite some people are voting. I see, so yeah, I'm seeing especially the 7 to 10 cents per kilowatt hour seems to be the most voted currently tariff rates. We're seeing also about 30% voting for between 10 to 15 cents per kilowatt hour, and somewhat less, about 15% between 4 to 7 kilowatt hours, and very few outside that. Excellent. So thank you very much for your results. It's very interesting. We can always bring come back to those to further discuss. But I would again like to introduce our first speaker, which is Arno Broad. Again, he's an infrastructure finance specialist at the World Bank. Specifically, he's in charge of structuring guarantees to mitigate risks for power projects. And again, as I mentioned, one of the pioneering projects of this is specifically the Scaling Solar program that the World Bank is. Well, I'll let Arno discuss in further detail. But he has a wealth of experience in a number of African markets with regards to solar specifically. And so I'd like to very much welcome Arno. So Arno, are you with us?
Sure. Yes, I am here.
Hi, Arno. Welcome.
Thank you very much. So should I go on with a quick presentation of the World Bank guarantee and then Scaling Solar?
Yes, please. Go ahead, Arno.
Okay. Thank you very much. So, I mean, good morning, good afternoon to everybody. As Borja kindly presented me, I'm working on in the guarantee team at the World Bank. So I'll just give you a very quick kind of overview of what the World Bank Guarantee Program kind of does, in case not everybody is aware of it, and then kind of present a bit more the Scaling Solar World Bank Group program that we have started to develop and what is happening right now. So in terms of, I mean, the World Bank Group is basically composed of 3 units. I mean, you have IFC, which deals with basically lending and providing equity to the, and I go back to the Scaling Solar presentation, but just, so IFC is really like lending to the private sector or providing equity. MIGA is providing some insurance, mainly for political risk, and the World Bank is providing loan and guarantees. So the loans are mostly to the public sector, and the guarantees are provided on behalf of the public sector for private beneficiaries. And that's basically where I'm working. So we have provided about 50 guarantees in 40 countries for about $30 billion of coverage. I mean, $30 billion of project coverage is a bit less than that. And really what the World Bank guarantees try to do is to help mitigate some of the risk, obviously, that developers are facing and lenders are facing in difficult markets, in emerging markets, especially like off-taker risk and public sector risk. It's kind of based on the strong relationship that the World Bank has with the government and with the Ministry of Energy and with the utility. So we are really kind of, we know what's going on in the sector, and we try to leverage this relationship to make sure that that the projects can go on. Really our interest is to make sure that the project keeps operating, that energy keeps being delivered, and that you have a sustainable deal between the private sector and the public sector. And also, I mean, what kind of makes this leverage is that for each guarantee we provide, we have an indemnity agreement with the government under which the country kind of commits to support the project and also to repay the World Bank any amount that the World Bank pays under the guarantee. So really the main value of the World Bank involvement is to help solve problems before they occur and before there's any default. So basically World Bank guarantee almost never get called, and they're really there to kind of help mitigate risk and help kind of be a bridge between the government and the private sector. So if we go now to the presentation on scaling solar, so if we go to the next slide, basically what the World Bank Group kind of realized, like I mean, a lot of you would be aware of that, is that right now, I mean, solar PV in Africa is not going at is not developing at the pace as one would expect, and as we can see in other markets, despite we see like a very strong potential and very strong needs. So there's not a lot of competition, there's a lot of transaction costs, there's a lot of risk that are perceived, perceived or real risk. And in a lot of those markets, there's very limited scale. So what we try to do is, what kind of instrument do we have within the World Bank Group, so including also IFC and media, and how can we help kind of package something that mitigates a lot of risk for the private sector, so that we can really, Africa can benefit from the most, the best prices, the best firms, and getting kind of sustainable, bankable deals. And that's where what Borja presented, that's really the key, is the bankability. And as we've seen in South Africa, I mean, obviously, the more the documents and the process were kind of known to people, the more the prices went down. I mean, in addition, obviously, to prices of equipment going down. So if we go to the next slide, basically the process that is scaling solar and that we put together is to first develop kind of documents, so like a standard kind of RFP, PPA, government support agreement, and we spent quite a bit of time internally discussing to make sure that we had something that we thought was bankable and that we thought was kind of sustainable and fair, a fair allocation of risk between the public and the private sector. So we did a lot of review, and obviously this is a very strong base when we start the project preparation, because the countries kind of already have these documents almost ready, and they just need to tailor them a little bit. For the developers, it's also very interesting, because once you have kind of reviewed and you know the documents from for instance, Zambia, then if there's another scaling solar tender coming up, like we are preparing one in Senegal, for instance, the document will be very similar. So obviously the cost, the upfront transaction cost of getting to know the documents and understanding the allocation of risk, what is really at stake, takes much less time. And so that's why, as you see, the first 3 steps of kind of project preparation, bid preparation, tender process, with all these kind of documents that are already available, we try to kind of condense this time as much as possible. And in Zambia, for this kind of first pilot 100 megawatt scaling solar bid, from the start of the mandate being given to IFC advisory side to the award of the bid, we had 9 months. So we are so that's quite a fast pace. And now we are in the process, as you can see in step 4, where we are kind of trying to get to financial close in the next few months. So then you can have quite a short construction operation, and basically in 2 years from start to finish, the idea is for government to have the possibility to have energy delivered. So I mean, by doing kind of a lot of work up front on the documents, we hope that now this is going to benefit not only one country but several countries who might be interested in the program. So if we go to the next slide, we can see basically what we're trying to bring as value here, which is kind of speed and efficiency, because I mean, obviously governments always need the power very yesterday, and having all this documentation, as I mentioned, kind of help us provide them something that they can develop pretty fast. Risk management, obviously having kind of mega insurance and World Bank guarantee that we staple to the request for proposal kind of allows the bidders to kind of choose whatever they think they need to mitigate some of the risk. So what is offered basically in the request for proposal for people not familiar is on one side IFC financing. So obviously the deal is bankable in a way because you already have an institution that's willing to finance part of it and to syndicate the rest. And also you have some risk management product that that equity or debt can use to mitigate some of the risks that they're still not comfortable with. And for the World Bank guarantee part, which I am kind of leading, it's a payment guarantee based on the payment security of certain months of revenues in the PPA, and we can also provide a guarantee for commercial debt if that's of interest. And so the last thing, the point number 3 on the slide is obviously the hope is that this will benefit several countries, and while Zambia might not have will not have the same kind of capacity to do so many rounds as South Africa, for instance. There can be a few rounds in Zambia. I mean, they've already announced for round 2 for 200 megawatts, but there will be something in Senegal. There's something in preparation in Madagascar. There's advanced discussion with Ethiopia. So basically, you cannot get this idea of scale, but within several kind of countries instead of being in just one big country. So if we go a bit to the next slide, we can see what happened basically during this pilot scaling solar Zambia round 1, where a lot of very strong, reputable developers kind of were bidding on it. So I mean, either at the pre-qualification stage or all the way to the end. So that was kind of a confirmation and a good news in a way that the documents and the structure that was put in place resulted quite attractive to the developers, even though Zambia is not necessarily a country that they would have put to a very high in their priority list. And if we go to the next slide, that you probably have heard of, obviously the prices that were obtained were quite impressive given the history of prices that we have seen in Sub-Saharan Africa so far, and are kind of in the range that I guess most people, according to the poll that was just taken, were seeing that, which is basically between 7 to 10 for most of them, and a bit lower for the first bidder, was kind of at 6 cents. Those are tariffs that are not indexed. So obviously, if you look at them in real time, they will be a bit lower. So they're kind of fixed term for the 25 years of the PPA. So again, that was a confirmation that if you put in place a strong kind of tender with balance, with an attractive risk allocation for the developers and the appropriate kind of credit enhancement, you could get extremely interesting and attractive tariffs for sub-Saharan African countries that so far have been a bit struggling to get the most of the prices and of the technology, of the solar technology, and I've been often kind of spending, and I have worked quite a bit in a few countries, and I've seen many governments kind of negotiating for years and struggling a bit to close deal and to get them really on the ground, and for prices that was sometimes quite higher than that. And so if we go to the next slide, we can just see. I mean, this is basically comparing some of the data points that we had in some of the prices that we observe and the time needed between the start of procurement and the financial close. Obviously, noting that Zambia has, I mean, this is a projected financial close because the financial close is planned for October this year. So this still has to be confirmed. But obviously, this kind of this again kind of shows that sub-Saharan African country can hope to kind of have deals at lower prices and close within a shorter timeline if they structure the process well. And if we go to the next slide, which is the last slide, I mean, this is very kind of general benefits, but obviously this is kind of things we have discussed, like speed, cost, certainty, competitive rate for government, for project developers. It kind of help open some of the market where they were not necessarily able to go before. The development time is kind of reduced, so that also kind of make it more interesting in terms of cost. And again, if you know the document, then you can go in different geographies, and you still kind of know the document, you know the risk allocation, you know the project that are offered. You can use the World Bank guarantees, you can use MIGA, you can use IFC financing, you can use combination of those. You don't have to either. And donors obviously can also be involved in financing of some of the studies, for instance, that are needed upfront to choose the site, etc. So maybe I'll just stop there so that we can also discuss a little bit. And just saying that, I mean, this is scaling solar is something that, yeah, the World Bank Group has developed, and we're quite happy to see the results in the pilot and see some other countries kind of doing it. It's obviously not the only way to do it. I think the lessons are more that if we can mitigate the risk and if we can make like a clear document and process, be it with scaling solar, with any other type of transaction advisory or any type of support, the key is really that Africa can really benefit from bankable deals in solar and from the best price and from the best developers.
Thank you very much, Arno. Very, very interesting presentation and overview of the Scaling Solar program. We are already receiving quite a number of questions and maybe a few points of elaboration. I mean, one of the questions that's come in sort of various forms is I think people had a hard time understanding. I mean, does the Scaling Solar program sort of select companies? I mean, are companies essentially providing just the EPC services, or are these companies really developing? I mean, is the land provided, or how are development costs covered? Could you maybe elaborate a little bit on that?
Sure. Yeah, and so sorry. I mean, I'm so engulfed into it that sometimes I forget the basics. But yes, I mean, it's really a PPP. It's really an IPP. So the company that bids on it will kind of, I mean, build, operate, and transfer the plant after 25 years. So basically, they would not just do an EPC; they would select their own EPC and manage it, but they would kind of be involved for the full term of the PPA, and they would really be managing the project from start to end. What happened in terms of land is that, I mean, part of the preparation process obviously is to select the land and something that is adequate in terms of, I mean, solar irradiation, in terms of capacity of the transmission grid to evacuate the power, and obviously capacity of the grid to integrate that power. So depending on the country, it might be a bit different. In Zambia, the government, I mean, provided the land basically, and there was a government entity called IDC that basically acted a bit as a developer for the beginning. So they kind of secured the land, they did some work, and the winning bidders in Zambia basically entered into a shareholder agreement with this IDC, whereby IDC would retain 20% of the equity. So in a way, you had all the land and all the kind of sort of development provided and done upfront by the Zambian company, but it wasn't free because they kind of kept 20% of the equity. In other countries, it might be done slightly differently, but in any case, the idea is to kind of provide, I mean, land and kind of these very basic and important things as advanced as possible, so that the bidders don't have any uncertainty and can really focus on doing their best for equipment, for O&M, EPC, and etc.
Okay, interesting. Thanks. Very good, good and in-depth answer. With regards, I mean, there's a lot of questions coming in, as I kind of expected as well, and also why we phrased this question at the beginning in the poll. I mean, I think a lot of people are really surprised, you know, pleasantly, but also I think worried, let's say, by this 6-cent tariff. Is there any? I mean, is there any risk that? I mean, is there still a margin for developers with such low tariffs? And I mean, also in looking, you gave in one of your earlier slides an overview of the tenders in South Africa and how significantly they dropped. I mean, Zambia, do you think that we would see a further drop? And yeah, I think there's quite some worry, let's say, by some of the international investors that this is quite, if it's doable. There's some questions.
Yeah, I mean, fair enough. This is a question I'm getting more and more often. I mean, when I look at it, I look obviously at, I mean, not just the lowest bid, but all the bids and kind of the range. So, I mean, there's a 6 to 10 range, which I think is consistent a bit with, again, with the poll that was made. Obviously, the attention focuses on the lowest one, and I mean, even between the first winner and the second one, there's quite a gap. So, I mean, I think time will tell whether, I mean, the first one and maybe the second one kind of went a bit aggressive on that one, or whether this is just a trend, and the fact that the package was quite attractive, you know, pushed people to really go low. So basically, I don't, I mean, time will tell. I don't really have the answer to whether this is going to be a trend, whether this is going to go down a lot. I was personally, and most of the people I work with, a bit surprised. We didn't expect it to go that low. I mean, I think it's good for Zambia, but we'll see a bit what happens in the next few rounds and whether this will continue or not.
Thanks very much. Also, I mean, with regards to another question that's coming in, with regards to sort of well, local content requirements and also just the general sort of growth of more African-based developers and EPC companies and these types of things. I mean, do you think that are you seeing, I mean, just in the logos that you showed us, some of the participating companies, obviously we're talking about some of the big multinational players, but is there room also within scaling solar for African developers to become involved, or is there some kind of longer-term goal for, or is there already, I'm not sure, with regards to local content requirements, is there anything that along those lines?
Thanks. I mean, yeah, that's always something that that all governments obviously considering that is part of the discussion. In Zambia, there was very little kind of in terms of local requirements. I mean, obviously there was a lot of encouragement, and we met with local developers, and by the way, in parallel, there was another process by the Ministry of Energy for kind of smaller plants that was maybe best suited for the local developers. But in any case, I mean, Scaling Solar really focused in delivering the lowest cost in the shortest amount of time. So to do that, I mean, we thought you really need to try to get the best companies in those competing together, and then kind of building and operating those plants. And obviously, I mean, we want to encourage, and we're trying to do kind of through other kind of World Bank program technical assistance. We try to kind of build local content and local capacity, but we don't want this to be done at the expense of the price that you will get for every customer in the country. Because if you can get, very cheap energy, you don't only benefit the small solar industry in Zambia, for instance, but you benefit all the industry and businesses and households in Zambia. So potentially you're creating more jobs, and you're creating more boost in industries by providing cheap power to everybody, rather than kind of carving out and kind of trying just to build the solar industry. So it's always a bit of a balance, and it depends. I mean, the government in the end is the one who decides. But we also try to keep in mind that we want lower tariff for all businesses and industries in the country.
Excellent. Thanks very much. I know maybe just one last question in this round, and we'll get into more open discussion. We do actually have, I know for all of you that are asking questions, there's definitely going to be a lot of questions here that I think that we won't have time to answer, because there's really a lot of good responses. We will also, I mean, after the webinar, we'll try to get back to everyone on some of these issues. But maybe, I mean, one key question, I think, and a good sort of rounding off one for the Scaling Solar sort of introduction. What do you think is sort of, I mean, and I know you're obviously, it's such an extensive package that you're working with, not just, I mean, through the entire World Bank group, but what would you say are one or two of the really key factors that have helped in bringing down prices so much? Is it, I mean, just mostly concessionary financing? Is it some type of preferential tax treatment, or yeah? What would you say are sort of some of the really key things that have helped and bring down these prices?
I mean, good question. As far as I'm aware, there's very little concessionary finance going into that. I mean, obviously, the package having like financing in the RFP, staple to the RFP, guarantees and insurance, I think it gave a lot of confidence to people that this is something that is going to happen, and that's this is something that is serious, and this is something that I already have a lot of kind of elements to put together my financing plan and my bid. So I think that really helped kind of bring more people, and the more people you bring, obviously the more competitive the bid goes, and the more pressure for bidders to kind of go low to try to win. The tax regime, again, as far as I remember, is kind of normal by international standards. It's nothing crazy. So it's really this package, and it's really, I think, also the fact that a lot of people have been willing to kind of get into the program early because they see the pipeline coming up, and again, not just in Zambia, but in different countries where we are working, and they see kind of this as a way to really take foot in on the African continent, where so far most of them have not been able to do much.
Excellent. Thanks so much, Arno. Really sort of in-depth answers to some of these questions. Again, there are really quite some questions that we didn't have a chance yet to answer. Hopefully we can get back to some of these at the end of the webinar, and if not, we'll be, in any case, we'll be answering, I think, some of these questions obviously during the event itself. I don't know if I mentioned earlier in the webinar, Arno will be one of our speakers, and I think in terms of, you mentioned that the financial close for the Zambia tender is sort of targeted for October, so that could be quite interesting, to discuss that further once we've seen the financial close and how things have gone to further go into this this topic as part of the conference. So yeah, thanks very much, Arno. Please stay on the line for some later discussion. But yeah, thanks once again for your contribution. Now I'd like to basically pass it on to our next speaker, Andrew Johnstone, who will also be joining us in Nairobi. He is the CEO of Climate Fund Managers. He's led and guided the startup and growth of infrastructure businesses in Africa in several parts of the continent, experience in countries such as Nigeria, Kenya, South Africa. Obviously, he's a very experienced and successful deal maker, working with equity investors, and leading a very interesting fund, which I will let Andrew himself tell you more about. But just quickly before we do go into that, I would like to launch one more poll question for you. And I'd like to ask, with regards to, we obviously just went into the Scaling Solar program, which is very much surrounded around the tender scheme for solar. We'd like to ask generally what do people, obviously we've seen feed-in tariffs. In fact, we could also go into a number of other schemes. We could talk about merchant solar, for example, or others. But I think these are two that we've really seen as some of the leading ones in a lot of the emerging markets that we're working in. And so it's interesting to sort of get an understanding of what people think or what people prefer, which scheme are people more sort of comfortable with and hope to see more of on the African continent. And obviously this can vary from one market to another, but I do see quite some interest and quite some votes coming in. So I'll just give it a few more seconds to just let the last few people make their votes, and we can publish that. But I do see some interesting. I don't think you see the results just yet, but I'll share those with you in a minute. Yeah, I think we can now share. And if you now should be able to see them. Yes. So yeah, we see quite relatively even split, but actually, so the feed-in tariff scheme is something that seems to be more popular. It'll be interesting to actually look at the analytics later, and maybe something that we can examine and see. But generally, we're seeing quite an interest in the feed-in tariff scheme. So yeah, thank you all of you for participating in that. And now I would like to pass the floor on to Andrew Johnstone. Andrew, are you with us?
Yes, I am, Borja.
Excellent, Andrew. Thanks very much again for joining us. Yeah, very interested to have you on board and hear some of your your input. So I will be passing the screen now to you, Andrew, so you'll be able to share your presentation with us.
All right. Let me just. There we go.
Excellent. Thank you very much. Yes, we see it. So please, yes, go ahead, Andrew.
Fantastic. Fantastic. Borja, good afternoon. The participants in this session, good afternoon to you all. What I'm representing in my presentation quite elegantly complements what Arno has just been speaking about, because Climate Investor 1 is really the counterparty to the great enabling work that the IFC has done and World Bank has done in creating the right enabling framework. So that is part of the story, because it's obviously a very necessary part of the story to create a platform for the private sector to participate in. What Climate Investor 1 is a response to that, that public sector initiative. And I'm going to tell you a little bit about what it is about, and then I'm going to conclude with some thoughts as to how the idea arose and maybe topics for discussion going forward. So in the first instance, Climate Investor 1 is all about energizing emerging markets. It is an initiative which spans the globe. It concentrates on emerging markets in Southeast Asia, Africa, and Latin America, with a key focus on Africa as its initial launch pad. The initiative is focused on renewable energy, and it focuses really on the three primary technologies of solar, onshore wind, and run-of-river. The specific applications which within each of those are quite generic, and I'll speak to why those particular technologies have been chosen in due course. The geographies, as I mentioned, are global emerging markets as reflected on the slides, and they are targeted really at jurisdictions that on the first instance have a power deficiency. Secondly, have progressive enabling framework development, like we've just heard about. And thirdly, already have some form of development activity currently underway. And that is because, as you'll see, Climate Investor 1 is a key respondent to what we perceive to be the needs of developers, but it is an enabler of further developers. It's not aspiring to be a primary developer in and of its own right, but rather to enable and create a sustainable market for developers to carry on developing new megawatts onto the grid, or rather into the homes. We have selected 13 target countries, which are also evidenced on the map, but that is not exclusively the jurisdiction of the fund, but rather just those areas that we see currently are the most progressive in providing potential deal activity. So this initiative has really been informed by and catalyzed by what we've observed and what we've experienced over time of doing project finance deals in the market. And while some of these are peculiarly power orientated, many of them, these characteristics or these barriers, equally attached to any other forms of infrastructure development, whether it be transport, telcos, whatever. And my colleague Arno spoke to some of the deficiencies they observe, and these are mirrored in some extent on this slide. But principally, we need developers to be a sector which is vibrant, that's sustainable, and that is profitable, and one that is sufficiently capitalized to do the early stage work. And we perceive this to be currently a barrier, is that while there are developers out there, they are relatively few in number, and there should be more, and they should have more support to do more quicker. We also see that at that early part of the wedge, the application of skills and technology is quite tactical. So it's driven by technical basis, and in many instances it's a little bit deficient in areas like E&S, social engagement, maybe even early stage financial structuring. And this is something that we're seeking to address through Climate Investor 1. The other thing that we see is undeveloped local markets. So while all the numbers may look good on a spreadsheet, when you actually go and try to procure the capital either in a currency which makes sense for the project, or even in a non-sort of local currency, that's where the difficulty becomes manifests, either by virtue of lack of understanding of the geography or other risk-related issues. So these are new markets. There are very few risk data points to hang investment theses off. And so further evolution of the local markets off the back of existing assets, we think is going to be a good thing. And the final thing that we've got here is, although it's not on the slide, but it's a issue of continuity of capital. Quite often, a project needs to procure capital from multiple different sources at many different times of its evolution. And if a developer or project can have an end-to-end financing solution right from the outset that has a line of sight to support its implementation, we believe that would release one of the biggest breaks which do exist, which manifests in a stop-start process associated to developers. So what have we done? Right, so recognizing those, we've taken the two generic themes of climate change and climate change mitigation as an investment thesis, which is early stage but enormous in its nature, of a global nature. We've combined that on the bottom left with the investment thesis that derives from emerging markets, demographic growth, the GDP dividend that's coming from emerging markets, and the recognition that on a look-forward basis, most of the new greenhouse gases, which pose a threat under climate change, will probably come from these markets. So combine all these three things together, and you've got quite a compelling investment proposition for the commercial sector to deploy capital into this region that not only has a bang for buck from a development perspective, but also makes good economic sense or financial sense. Climate Investor 1 already exists. It is an initiative which was launched at COP, and it is out in the market, and it already has 3 projects under development. And so while it is still in the capital raising stage, it is already deploying capital. What exactly is it? The Climate Investor 1 facility actually comprises 3 separate funds. It has a fund that focuses exclusively on the development stage of projects. That is then followed on by a second fund, which focuses exclusively on the construction stage as a shareholder of the building out of the asset. And then it has a third fund which mobilizes once the asset is up and operating and after the latent defects period, so COD plus 12 months or so, and it provides gearing into the project. And I mention this because by implication the construction equity fund actually funds a project entirely with equity. So it removes during the construction stage the use for debt, and therein lies its unique nature. And I'll explain when I come to the close why we think that makes sense. The final point to make on this slide is that a project traverses through all three of these funds. So what a developer can have line of sight to in getting support or a relationship with Climate Investor 1 is an end-to-end financing solution which will deploy capital at the right time in the project's evolution, and the capital that is being deployed is the right type of capital. And what I mean by that is the capital that's being deployed in the development stage is derived from donors. It is very risk tolerant, it has a low cost to it, and it's most suitable to be deployed into projects at that early stage. The flip side of it, though, on the refinancing fund is that is largely institutional capital. It's pension funds, insurance companies, and those are the type of institutions that are very keen to get exposure to this type of asset, but are not comfortable with taking construction risk. So through the construction and all the architecture of the fund, we have designed a financing facility that not only links the right type of capital to the project at the right time, but it does so in a continuous nature. What this means, practically, is within the construct of the fund, there are actually 5 individual investment instruments. And this is relevant because it gives us the opportunity to go out into the market and to the financial sector and not just offer them one solution or one investment opportunity that they may like but may have to grapple with bits they don't like. Here they can determine whether they want to be exclusively involved in the development stage or in the construction stage or in the operating yield stage. What you're looking at here, ladies and gentlemen, is the manifestation of something called blended finance. It's a structure whereby capital is procured from the public all the way through to the private sector. It's molded and blended together in a managed and transparent way, and it's deployed at scale into projects. And it's the deployment which is really the interesting part to me. So the next couple of slides talk to actually the mechanics of how the facility works. And if I draw your attention to the schematic on the right-hand side, what you can see there is a developer or a sponsor who's got a project company or project idea, and the development fund will deploy and co-develop with the developer, which is required to bring that project to fruition. Now, that process could be either in response to a scaling solar opportunity, or it could be part of a Get Fit program, or it could be an unsolicited bid process. We are agnostic to the process which is followed. We do absolutely endorse the scaling solar type of enabling framework, because the 2-year door-to-door that Arno spoke about is exactly what we're aspiring to do here. Once the project has got to commencement of construction, what then happens is the construction equity fund deploys and capitalizes the project company with equity capital, part of which is then used to repay both the developer as well as the development fund its costs plus a small premium just to cover its costs. So the project is then built out with equity in its entirety. It reaches COD and it gets implemented and works through its latent defects period. Once it gets to that stage, we then effectively gear the project. And we do so with the core of the refinancing fund, but augmented by local capital. So this is where I draw your attention back to the earlier point of developing local markets. And through the catalyzing effect of the refinancing fund, so we'll be able to deploy and induce local capital and different types of capital, institutional capital as opposed to banks, into existing yielding assets. And some of that capital will then be deployed back to the construction equity fund and the sponsor. And those, a bit of a messy picture, but what this is reflecting is the redeployed capital back to the construction equity fund gets reallocated and reapplied to the next project. So there's a recycling characteristic to this facility, and the consequence of that is that ordinarily with a fund that is of $500 million, for instance, which is a construction equity fund size, one would expect to be able to get 7 to 8 projects out of it. Through the recycling of it, that's evidence out of this mechanism, we anticipate being able to build 20 projects out of the program. And that's material because really the intention of this is to achieve two things. One is to get new projects established and off existing assets to mobilize new forms of capital into this, and also to, through the repeated application of money at the early stage of the process, to support and grow out a much more vibrant developer market. But it's not all about the money, it's not all about the numbers. What the program will do, through these 20 renewable projects, we anticipate will add 1.5 new gigawatts of power onto the grid, new connections for a lot of people. Importantly, it's all about catalyzing money. We all recognize that while there are some big numbers out there, in truth, it's not enough. What blended finance seeks to do is through the combination of private and sector money to have a 1 + 1 = 3 outcome. So the ability to actually deploy $1 billion through Climate Investor 1, we believe will catalyze another $2 billion in deployment, and that's important. Critically, it's about greenhouse gases. This is, while it doesn't look and feel very much like a power initiative, its origins lie in climate finance, and so greenhouse gas avoidance is central to what this initiative is about. And then there is a very strong development theme associated to this, which is creation of jobs, both direct and indirect. Importantly, that final point is critical because of the jurisdictions in which we are seeking to operate. And forgive me for the slide, but what it is actually showing is on the left-hand side, you have most of the jurisdictions in which we are targeting, being those 13 countries I mentioned in the emerging markets. They tend to be on the left-hand side of the Human Development Index, which is shown on this slide. And what you can see on the left, on the x-axis, is your contribution to Human Development Index and development is infinitely greater on the left-hand side with incremental additions of electricity into the economy than it is on the right-hand side. So in terms of bang for bucks, from an HDI perspective, mobilizing, deploying capital through the provision of power into emerging markets makes the most sense, and this is very important in mobilizing the public sector part of the blended finance thesis. This initiative it comes out of FMO, who I'm sure many of you are very, very familiar with, very well established, very well mobilized, and very well respected development bank out of the Netherlands, extensive experience in emerging markets and renewable energy, operating out of the Netherlands, and its partner, Phoenix InfraWorks, which is a new startup business, which has quite extensive pedigree in establishment of funds, investment activity, and renewable energy. This is a business, Climate Fund Managers, that currently exists. It's located both in the Netherlands as well as in Africa at the moment, and has people on the ground, and if anybody is interested in having further conversations. We've got people with whom you can engage. The things that I'd just like to maybe close with, which are these closing thoughts, which link back to the Climate Investor One thesis, is the following. Probably one of the most talked about words or used words in this space is bankability. And bankability talks to the ability to coalesce enough people around a concept that is evidenced through a forecast of models and articulated through documents that gets sufficient consensus for everybody to say, let's go. Bankability is a concept. It's absolutely in the eyes of the beholder. What is bankable for one party is not necessarily bankable for another. And so what CIO seeks to do is actually to minimize the number of eyes involved. And so through the deployment of end-to-end capital, the deployment of equity capital, one can reduce the number of parties one needs to mobilize a project, and without oversimplifying it, the fewer people you need to say yes to mobilize a project, the better. The second thing is timing is key. It's absolutely key in terms of projects. I applaud the World Bank's work on Zambia, and also this pursuit of getting from door to door in 2 years from early stage development to actual completion of construction is not only an important goal for us all to have, but it's also very important. It's almost critical. Election times in any jurisdiction are bad times to try to do a project. And so one should try and scope your project and mobilize capital in that window of utility, that political window of utility that is supportive of projects. That's what we're trying to do through Climate Investor One, minimize development time by making sure that development process is fully funded and minimize the time it takes to say yes to implement capital into the construction phase by reducing the number of people that you require. The third point, for those of you who have been involved in the development of projects and used project finance, typically stress happens either during construction or just after it. And that's just a reality. Stress on a balance sheet of an early project or early company is never a good thing. So we've sought to address that by making that balance sheet as robust as possible by using only equity during this period. Because as you know, equity is much more absorbent of shocks. And so during this period where there's more probability to balance sheet stress, the use of more equity has got to be a good thing. The next thing is revenue models are changing. On-grid power sites, long-term PPAs, creditworthy off-takers, nice to have, but few and far between. The reality of it is that most people who are currently off-grid, certainly in Africa, will remain off-grid. So the pursuit of off-grid and distributed generation models is very important. They're already emerging. Their potential from a commercial perspective, investment perspective, is enormous, but it does require different risk and funding models. And while we're certainly not putting our hand up to say we've got the model. What we believe we have got is the type of capital that can entertain and pursue such models, and certainly the mandate and the mandate agility to consider and to flesh these type of new risk and funding models out. The final point I want to make, which ironically was a topic of the previous discussion, is let's be aware, just beware of the race to the bottom on pricing. And while it is absolutely important that a procuring entity and a government gets the lowest tariff possible, I think there is a real risk of overshooting the mark. And I think we need to be cautious in applying a generic dollar per megawatt across geographies, agnostic to different peculiarities of geographies, either from a risk perspective or their stage of evolution. And I think there is also the risk that it does set a precedent that is not only slightly off-center, but also is concerning for the private sector to mobilize into it. Those are just thoughts for consumption. You'll see some of those linked back to the thesis of Climate Investor One, but it probably contributes more to the general conversation of what are the issues that are confronting us in these markets. Volker, let me pause at that point and see if there are any questions or any thoughts that have arisen from this presentation.
No, excellent. Thanks so much, Andrew. It was a very sort of in-depth presentation of Climate Investor One, what you're doing, and I especially do really enjoy these last closing thoughts in bringing about some of the sort of larger issues. And I do think that this brings up, and in fact, there's quite some questions surrounding some of the points, especially that you made in your last slide. I mean, I think clearly one of the ongoing sort of themes that seems to come up in this webinar through the questions that I'm seeing here is the issue of price, and you mentioned also this race to the bottom. People are wondering, is Climate Investor One doing anything specifically with, I don't know to what extent, if you're working with governments is there anything that Climate Investor One is doing, or any suggestions or ideas that you have that can be put in place to try to avoid this race to the bottom?
Not directly is the answer, but in thinking about the question that you posed earlier on, when you look at the sequential rounds of pricing that came out of, for instance, South Africa, which I'm sure would be a feature of a similar program run elsewhere, is that what happened with the various rounds, the savings came from the following, in the following order. The first compression started with development premiums, and the development premiums paid and earned in successive rounds were lower than the first round. And the reasons for that were not only that the market became more competitive, but more importantly, the process became less risky. The process, once you're into round 2 and round 3, is far more predictable. The documents are far more understandable. There's a lot more precedence involved in that exists in terms of concepts, and so the risks associated with that process are much lower, and accordingly, more people in it, and the premium then accordingly gets reduced. So, firstly, the premium goes. I think the second is we can't underestimate the significance of the drop in price of equipment. The cost of panels has come off dramatically, and that has been a big contributor over time, not only to programs, but just as a natural evolution of the technical pathway. The third thing that has come down is financing costs, and that's across the range. You know, it's both equity returns as well as cost of debt. It manifests in things like reserve accounts, provisions, all these type of things which contribute to the overall cost of funds, and those are the three things that have materially changed and will continue to change going forward. So, in answer to your question, what does Climate Investor One do in respect of any of those three? Well, it's actually the third one. You know, I think that where we're talking about cents per kilowatt, largely that's talking to and informed primarily by the cost of the equipment. The cost of financing hasn't changed that much, and I would suggest that even at a project level, for those of you familiar with project IRRs and EBITDA costings, I would suggest that the cost of funds of these type of projects, even through the rounds, hasn't changed that significantly. What we are seeing across the regions is project IRRs that range from high teens, high single digits in local currencies, which I suggest is to probably a more sustainable level around about 13 to 14% at total cost of funding. So that's your project IRR. That's the type of thing that CIO is focusing on. It's focusing on making sure that the cost of funds is not only predictable, but it's sustainable and it's reasonably priced.
Excellent. Thank you very much, Andrew. I mean, there's several questions, that are coming in. I would like to also loop in Arno back in a second. But I mean, one of the points that you brought up, which is obviously very interesting, your very first point on this slide, and I know we spoke about this a few weeks ago as well, is the issue of, yes, bankability being in the eye of the beholder, and in fact, yeah, different stakeholders looking sort of for different, or considering different factors when they consider a project feasible or not. I mean, one of the questions that came in, or more of a comment that came in from one of the participants, is with regards to the poll that we had, with regards to the feed-in tariff scheme versus the tender scheme.
Yes.
I think a lot of people say, I mean, if you'd asked, if we had a predominantly government attendee sort of list, I think we would have seen something quite different. I mean, I think that the fact that we've seen a 59% or a majority of people looking more towards a feed-in tariff. I mean, you see this as really the sort of more commercial focused. I mean, yeah. I mean, with regards to this, sort of for Climate Investor One specifically, what are one or two of the key points that you considered in deciding whether a project is bankable?
Land for me is critical. I think that the land question remains unanswered in many jurisdictions. I think it's an enormously complex issue. I think it ranges from, in some instances, a lack of comprehensive registry, so it's difficult to actually know who in fact does own the land. It traverses through instances where even if there is a registry, the ownership of it is governed by things that range from some form of understandable bit of legislation through to tribal custom. There's a lot of emotion associated to land and tenure and sovereignty, and I think that there's no clear solution to that. In addition to that, it's overlaid with some jurisdictions where, in fact, non-nationals can't own land. So the whole issue of land for me is difficult, and that's probably one of the things that detract in my mind from solar as a technology, because it is so much more land consumptive than potentially wind or hydro. Having said that, let me just add, the rivers are equally emotional as land is, but I think that's the biggest challenge for us, to be honest. So in looking at a deal, that's the first thing we look at. How understandable is the land aspect of this? And not only is it a case of how understandable is it at the outset, but recognizing that these are projects in which your money is going to sit for up to 20 years. If there is an issue that arises around land, how's that issue likely to be? Are there mechanisms in place to solve or address conflicts, disputes, issues associated with land, because those are the difficult ones to fix. So I'd say land is number one.
Okay, thanks so much, Andrew. Yeah, no, that's a really, I think, also a good explanation of why you consider land to be one of the key topics. I know I've been hearing this from quite some, maybe not as the most important, but I think this is, clearly, one of the most important. I'd like to also pose the same question to Arno, if you're still with us. Arno, I mean, with regards to sort of the World Bank, or you specifically, what do you consider, in your eyes, what would you say is the key element when considering bankability of a project? What is the one or two key points that you consider? I mean, would you also agree with Andrew with regards to land, or do you see other points being more important?
Yeah, I do agree that land is very important, and that's why we kind of put so much focus into trying to take the uncertainty out of the land. I mean, ownership, resource assessment, etc. I mean, after I look at a lot of PPAs and other documents. So obviously, I think lenders and financiers will look a lot at what recourses do they have if things go wrong, and that includes kind of regular payment default, and that includes kind of the biggest force majeure and termination type of clause. So I think there's a lot of the documents are structured to make sure that there's enough recourse to kind of solve the issues, but there's also kind of more dramatic things that they can use to get out of the deals in a way that people will get repaid and would be fairly remunerated for the investment, both on the equity and the investment and the debt side. So yeah, all those clauses are structured, and the credibility of the people taking those engagements is obviously key, and that's why sometimes we are asked to kind of stand by, backing some of these obligations, because they can be well written, but if the people that take them don't necessarily have the credibility for the investors, then they are not worth a lot. So if we can just stand back and give them a bit more, enhance them, and make sure that they would be applied if things happen, then it usually kind of helps.
Okay, thanks very much. And just sticking with you as well, Arnaud, and I'll pass this question on to Andrew as well. I'm curious, because this is also one of the questions that's come up quite a bit, and even also in general in conversations with a lot of the stakeholders that are looking at Africa, a lot of the developers and investors. Grid connectivity, grid limitations. I mean, a lot of the infrastructure, a lot of the grids that are operating currently in Africa, a lot of them obviously are outdated. There's also a lack of capacity. There's the issue of obviously the intermittency. I mean, how much of this is an issue? And obviously a lot of this is driving a lot of people to look much more at off-grid solutions. I know Andrew mentioned this earlier, but how big of an issue do you see this being? I mean, is the grid? I mean, what state? Obviously, it will vary from market to market, but generally, sort of looking regionally, how big of an issue is this, and what's being done to address it?
I'll get started quickly, but yes, I mean, this is obviously key, and that's again something that is expected during preparation, to kind of look at the grid, the capacity to integrate renewable power, and the capacity and kind of the transmission capacity at one point to evacuate the power, because obviously even if you have a take-or-pay agreement, but in the end you don't get dispatch, you're in a tough situation to get paid. And that's not something anybody wants to be in. So that's really key. And I mean, for instance, in Zambia, you have a very large hydro system. So adding 100 megawatt of solar intermittent power is not an issue at all. But obviously, the more you keep adding, then you need to be very careful of where you're adding it in the country, in the grid, and whether you're kind of still in a zone where the grid reliability can be managed.
Excellent. Thanks so much, Arnaud, for your answer. Maybe Andrew, you could give your take on this. How important, how much of an issue is the grid?
I think it's very important. I think that not only from a technical perspective, but also just from a sustainability of the asset perspective, downtime just costs money. So forced outages because of grid instability, or transients in your grid that feed back into your plant, are all bad from a technical perspective. I think being constrained off is not good from an engineering perspective, nor from a cash flow perspective. So grid stability is vitally important. And it's unfortunately not something which can be just ring-fenced and left and said, well, it's got to get sorted out, otherwise we can't do wind parks. I think that the onus sort of lies with the developers to come up with the combinations that, again, the risk of being too simple, to say, well, let's try to pursue a strategy which adds one part base load and two parts variable load. And we've seen some such proposals which are linking PV with run-of-river hydro, or PV linked to pump storage hydro, or hybrid solutions. And I think it's necessary. Because variable power is variable power, and there's the challenge clearly with it is that as one moves more into the transmission side of the business, so you start getting into a number of more complicated financing and asset-related issues, because those usually sit within a single entity like an Eskom or KPLC. But I think it is a very important part of the mix.
Sorry, I got disconnected there for a second. Thanks so much, Andrew, for that. I mean, obviously this issue, and that leads sort of to the next question. I mean, I know that the key focus, obviously, of this webinar was not so much on off-grid and distributed generation. I did mention, and for those of you that are asking, this is a key topic that we're going to be discussing as part of the conference. As I mentioned again, we have these three streams. I think, Andrew, you mentioned yourself that yeah, the needs are different. There's a different type of funding and financial model that needs to be established for this type of. But Jenna, I mean, is this an area that you're looking at, Andrew? Well, later I'll ask Arno. I know that the World Bank is involved in this, but is this is Climate Investor One or any other? I mean, is this an area that you will look to get involved with?
Sorry, Borja, and specifically into what?
Off-grid and distributed generation.
Off-grid, absolutely, absolutely. I mean, I think that the Climate Investor One's aspirations is not necessarily one of universal access, but to the extent that it can facilitate and expedite new power connections in whatever form, it will seek to do so. You know, the role, and I draw you back to one of my earlier slides where I made reference to this concept of blended finance. The point of blended finance is to bring pools of capital together that fit together in a complementary way and that result in a risk profile that is attractive to mobilize commercial sector money. So what is recognized by governments, donors, DFIs, host governments, the likes, is that within that community there's insufficient money to actually solve the problem, and by a long shot. So the solution's got to lie in using that money in a manner that creates platforms to mobilize commercial capital at scale. So the solution of how do we actually address off-grid or distributed generation, how do we actually apply our minds to new revenue models and new risk frameworks, in large part lies in how do we use that form of funding, being from donors and DFIs, in a way that fills those spaces that makes commercial capital currently uncomfortable to move into it. So yes is the answer, slightly more complicated answer, I'm afraid.
Okay, excellent. No, thanks so much. And again, you know, these are an entire segment which will be deepening in, you know, getting into a lot more deeply during the conference. We have actually gone, you know, now 20 minutes over our scheduled time. I actually think, I mean, as I mentioned earlier, there's a huge number of questions that haven't been answered in this webinar. We will follow up. We have recordings of all of these questions, so we will follow up. It's actually very helpful also in establishing what are some of the key topics that people are looking at in terms of the financing and moving their projects forward. One very sort of last closing question, which I'd like to ask both Andrew and Arno. Maybe we can start in this case with Arno. I mean, you mentioned one or two, I don't, but what are some of the, I mean, with regards to scale, but also more generally, what are some of the markets specifically that you see with the most sort of potential over the next few years?
Thanks, Waha. I mean, obviously there's a question of size. I mean, you look at a country like Nigeria, we just signed a few PPAs for solar, and in terms of size, I mean, obviously there's going to be potentially a lot of this happening, and I mean, same for maybe places like Ethiopia. After, I mean, in other countries a bit smaller, like for instance, I mean, Madagascar, where we're just starting to work with the government, those will be smaller markets, but compared to the size of the grid and size of the country, you can expect quite a significant development. So I would say, I mean, if you look at the big ones, Ethiopia, Nigeria come to mind, but I would expect a lot of projects even in the smaller countries, and really that to happen all over the continent.
Excellent. Thanks so much for your answer, Arno. And Andrew, maybe you could comment on some of the interesting markets from your side.
Yeah, I must come up with the same answer, to be honest. I think that what we've witnessed is that programs work. You know, programs are more successful in delivering positive outcomes than individual projects. For the obvious reason that that you get a bigger market that responds to it. The prospect of actually, if you're going to lose projects in round one, you might have a chance of winning them in round 2 and 3 and 4. So programs work, and to have programs you need scale. So I agree, areas like Nigeria, the larger market, South Africa has already proven. I like Ethiopia. I think Ethiopia's got enormous potential, and it's showing very positive signs on it. And I think Central Africa, I think that the renewables and certainly solar space has probably got more of a bias towards East Africa than West, where one would expect to see the utilization of more gas and gas distribution, gas models. But a similar type of answer, I think. It's those jurisdictions that have got size, and importantly, those type of jurisdictions that embrace the initiatives like scaling solar. We can't underestimate the significance and the impact of creating a level playing field, a clear, transparent playing field that people can get onto. So that's probably as important as the actual scale of the size of the market itself.
Thanks so much, Andrew. It's really, I think that's a great way to sort of round things off. I'd like to thank both of you for your time, but also, I mean, especially, I'd like to thank both of you for the work that you're doing with your amazing initiatives. I mean, as I mentioned before, Solarplaza, our mission is really to accelerate the energy transition, and we have a special focus on emerging markets. We really see so much potential in Africa, and as you mentioned, I mean, these types of programs work, and they're absolutely necessary. So it's really interesting. A lot of the questions that we've been getting are very much specifically about requirements that you have for developers and investors that you're working with. Yep. So we'll definitely sort of try and funnel some of those questions to you. I would like to mention again, to everyone that both Arnaud and Andrew are going to be with us in Nairobi. So you'll have a chance, obviously, to meet them in person and discuss much more in depth. We'll have a much more in-depth program where we can discuss these issues at length. And also regarding one specific question that came up in both presentations, which I didn't purposely avoid, or somewhat did, is with regards to currency and currency risk. We will be actually having a webinar specifically on this topic, an entire webinar dedicated to this. So we didn't go into it, but I know, in conversations that I've had with both of you, that this is also something that is important. So again, thank you so much, Arnaud and Andrew. It's been really a very interesting webinar. We went over, almost half an hour over time. So I apologies to everyone for that, and I hope you all enjoyed it. I definitely know I could be, continue these conversations for several hours more. It's very interesting. So thanks again, and yeah, look forward again. Evelyn and myself are both available. For any questions regarding the event, you have our contact details on the screen. We're available for you. And again, Andrew and Arnaud, thank you so much.
Thank you very much. See you in Nairobi.
Perfect. Yes, look forward to seeing you in Nairobi.
Thank you very much from me as well, and maybe just for the people who still remain, if they do want to reach out to us, if I could just refer you maybe to our website, which is climatefundmanagers.com.
Excellent, and also, yeah, specifically, if you do want to be, have more specific questions for our speakers, you can also feel free to follow up. We can funnel, get you in touch as well, directly with Arnaud and Andrew. So yeah, thanks so much again. Look forward to seeing as many of you as possible in Nairobi, and yeah, we're available for any questions. So again, thank you. Everyone have a nice evening or morning or night, depending on where you are in the world, and thanks again.
Excellent.